Here we are. We are live. Let me see if I can bring in Zach Molzer here. We've added Zach Molzer to the stage. Good morning, Zach.
What up?
How's it going?
Oh, just another day solving the world's problems.
Fantastic. All right. This is the first installment of hopefully more of Coffee with Zach and Dave. We're talking real estate development. We're talking Kansas City and St. Louis. All the good things happen in the state of Missouri. What is on your radar today? What do you got for us?
Just solving the world's problems. Gonna have just got done with a meeting with the attorney for a project that I'm getting ready to start. I'm under contract on. Have a closing call meeting today. I lost a bet, so I have to take my superintendent out to lunch. Chatting with one of my other partners about a duplex project, and then a little networking tonight. So
tell us about what's in between. What can you tell us about your next project, Zach? So Zach, for those who don't know, and those that might be watching, Zach is currently redeveloping the historic Aladdin Hotel in Kansas City. Give me the specs. How many apartments is that, and where are you in that process right now?
Yeah, so the Aladdin is on 12th and Wyandotte, downtown Kansas City, Missouri. It is a 16-story building built in 1925. It was first built as an apartment hotel, travelers hotel, and then apartments. Hosted Mickey Mantle, Greta Garbo, Al Capone back in the mobster days. So what we're doing is we bought it and we're completely gutting it, floors 3 through 15. And when we're done, it'll be 122 apartments, top floor cocktail bar, and about 20,000 square feet of amenity space.
So Zach, when we met, because I saw the article about this project and I loved it. I remember watching this thing go on auction. And tell me about your thesis for the Aladdin Hotel and specifically the target audience and price point that you are building for.
Yeah,
some of the choices you've made around that.
Yeah, so I mean, you go look at bigger cities, Chicago, New York, et cetera, where they have smaller units that are more targeted towards newly grads. People up in those cities making probably $100,000 a year, which is like $50,000 here in Kansas City. And there's been one project here in Kansas City that's been like that, Midland Lofts, that Quarters Companies did, where they proved out the model of smaller units that are more efficient, that individuals that are first graduating college with a 4-year degree making $50,000 to $60,000 a year, they can't afford a $1,800 a month apartment. They can't afford anywhere between $1,200 to $1,500. But the general rule of thumb is you don't want to spend any more than 33% of your income on rent, right? And so with the Aladdin, our target is those newly grads making $50,000 to $60,000 a year. Average square feet of a unit's about 550. Average rents are about $1,450. So it's really curated and targeted towards those individuals. Bigger bathrooms, bigger closets, smaller bedrooms, because again, people they need a place to sleep, a place to shower, go to the restroom, to change clothes. But ideally, a lot of their time they're spending in all the different amenity spaces that we'll have, or downtown, live, working, and playing downtown, all the bars, restaurants, et cetera.
Now, you gave me, I think, an interesting perspective when we were walking through as far as the size of the units and the rents and kind of what you thought that would do for downtown. I think you just answered that, which is what we see sometimes in our market. I think a lot of other markets, especially when you see new construction, is they are building spaces where they want to keep people in the building. And that's good if it's keeping people in the building as building community and making it an attractive place to be. But I think you also shared that part of what you're doing, both with the Aladdin and then you can tell us about your next project, is that community extends into downtown and all the other things that are happening in downtown Kansas City. Yep. I personally have been screaming from the rafters how excited I am about the highway cap that they just announced and what that's going to do to connect. What's the section between power and lights up to the other side?
The highway cap will be 4 caps that cover the highway, similar to the park down in Dallas. But it'll be it connects the downtown urban core, the Garment District, and the Central Business District with the Crossroads, which the Crossroads has seen unmatched revitalization and upward trends. Same thing with the downtown area. And so being able to connect both of those with a green space is awesome. And then obviously right outside of the Aladdin, the city's investing $120 million into a brand new 600 stall parking garage, as well as a massive green space and park, called Barney Allen's Plaza, which is also really exciting and a huge momentum for the Aladdin, where our residents will be the only building in all of downtown that have, in a sense, their own park, which is pretty cool.
Absolutely. What can you tell us about your next project?
Yeah,
or the next big one you got under contract?
Yeah, a little different than the Aladdin. Still a historic building, not using historic tax credits though. It's not on the registry, so this one's more of a timing game. Smaller project. It'll be about a $5 million project all in. It'll be lofts, some office space, and then a rooftop bar. So should be pretty cool. That's also in the heart of the Crossroads, which is really exciting. Plenty of parking, etc. So we're really excited about that one. It should be fun. It's a little different, obviously. Definitely a different curated space where not taking the approach of smaller units. The units here at this one will be massive, and there's really no comp like it. They have floor to ceiling windows, 12-foot ceilings, industrial, 1,500 square foot units, where it's in a way this project, because there's not that many units. It's an entertainer's goal, right? It is curated towards maybe a bachelor, 30 to 35, likes to have friends over and hang out. Maybe it's just a DINK, as they call them, I think, dual income, no kids.
Dual income, no kids, yeah.
Yep, a DINK. DINKs that want to live there, that, again, want to host, want to have a really, really cool spot to showcase everything, to show their home off, etc. So picture condo style finishes, but for rent.
Amazing. So I've had this theory for a while now, especially as I look at the office to residential conversions and some of the tax credit legislation that's going through the Missouri State Legislature. My thesis, and you tell me what you think about this, I think that what you're doing at the Aladdin is a perfect application for a building like that, particularly with the size of the building and the floor plans you can achieve, because the level of finishes you would need to do something bigger would put the rents out of reach. However, if you can enter some of these office buildings at a basis that is extremely low, my thesis is you can do like Soho style artist lofts that have a limited finish. So you're not doing as many units, but you're just taking up more square footage, and get a similar rent comparison depending on your acquisition and how many units you can put in there.
I think it all depends. I'd say 95+% of office buildings cannot be converted to apartments. When I say cannot, anything is possible. You can do anything. I mean, it's just money, right?
Right.
But it has weird floor plans, weird layouts, and more importantly, doesn't fiscally make any sense. I always tell people it doesn't math. I mean, there's a couple projects even here in Kansas City that unfortunately proved that out. It just doesn't work, right? You could buy a building for $1 million. It could be 200,000 square feet, and it still just doesn't work. The cost to redo all the plumbing, HVAC, electrical, fire suppression, elevators, all new wall partitions, everything. It's just still doesn't generate the income needed in order to do so. Sometimes, unfortunately or not, it is more financially responsible to tear the thing down and rebuild it back up, something else, right? Now, that's though for buildings that are historic, you don't want to do that, but there does need to be enough of a basis reset. Obviously, the new historic tax credit legislation that's still ongoing. It's not like anything's into effect right now, but that should be able to help things. It's more challenging in areas that are not like New York or Chicago, where you're not getting $4 plus square foot rent. Your cost, for example, here in Kansas City, it is more expensive to build here in Kansas City than it is somewhere like Dallas, but Dallas has higher rents. So how in lower cap rates. So how in the world is that going to work when, it costs me $300,000 a unit to convert a building and I'm only getting $2 a square foot rent, when down in Dallas, that same building would cost $250,000 to a unit to renovate, and they're getting $2.50 square foot rent, right? Those those numbers work a lot better. And so it is a big math equation. I would say that the hardest part for most people is not getting too attached to the idea of, oh, the basis is great, let's do it. I will say the one thing you can't change, and that it's a great investment thesis, is basis. It's the only thing that can't change. Location can change. You can't change location, but location can change. Things can go up, things can go down. Basis doesn't ever change. But unfortunately, sometimes even that isn't enough to make a project justifiable. I was looking at a project a couple weeks ago, and the only way to make it work is if the owner would write me a check for $500,000, and then it would maybe work.
Yeah. I think I talk about this all the time in St. Louis, because there's all of these big projects being announced. There's kind of constantly this churn of, how do we bring back downtown? How do we create enough supply to generate its own demand? And in one sense, activity does create activity, and quantity is a quantity all of itself, right? These kind of old truisms. However, the issue we have in St. Louis specifically, and you can tell me what you think, what's going on in Kansas City, is that when you look at these projects in a vacuum or just in a spreadsheet, they can make sense until you factor in there's no demand. Our net population growth on a 5 and 10 year, 30-year trajectory, both backwards looking and forward looking, is negative. And St. Louis recently just had a great article about how there was 30,000 immigrants that came to St. Louis. I think it was between 2023 and 2024. And that's terrific, except in the absence of those immigrants, the population would have dropped like an additional 25,000 people. Like so when you think about the cap rates, cap rates are a forward-looking expectation of return, and the risk people are willing to take with their capital today. Dallas, obviously, Texas has some different labor laws, which helps, but the idea that you can build so much cheaper there than you can in Missouri should wake people up. But I also look at if your capital that can move across the country pretty seamlessly, it's excuse me, that's my dog in the back. If you have capital that can move seamlessly across the country, that isn't bound locally the way that it was even 15 years ago, they're going to go to the place of least resistance. And so the obstacle we have in St. Louis, and I suspect a little.
I was saying, like, at the end of the day, people building things in development, developers are going to go places where they make money, whether people like that or not. Like, this isn't charity work. I love that I'm creating a community and I'm building in my city, and I'm all these benefits. I'm creating housing. I'm doing all these good things. But at the end of the day, it's still a financial return metric, right? I have investors that invested in this project because they think that they can get a greater than or equal to return than the risk-adjusted return, right? And so if you're a developer and you could go build in Kansas City and make $5, or you could go to Dallas and make $8, the only way in which someone would come to Kansas and choose making $5 over $8 is if to make the $5, it was a hell of a lot easier, right? Less risk. Right. People are going to deploy money and they're going to build no matter what. In theory, it's how do you incentivize people to build in your city? And I think there's just sometimes some misalignment between city staff and cities in general, and even just the people in the city, and development and developers of projects, right? Whether that be affordable housing, market rate housing. I wish more people understood the metrics of supply and demand. That would make things a lot easier. If you build more housing costs go down. Therefore, things are more affordable. That's kind of a foreign concept to most people, but I get it to some extent. We need all different.
That's so long as you have the demand, right? Like if you build
Correct.
more and
that's
there's no demand.
It's like in St. Louis, you're talking about the population decline and all that. That is one thing that Kansas City doesn't have. We have upward trends of population growth.
Yeah.
We have the highest year-over-year rent growth in the country right now. But and as cool as that is for me as a developer, of like, yes, I love rent growth. That's a great metric. That also translates to meaning we don't have enough things getting built. A fun but interesting stat is The Aladdin will be the only apartment project that's larger than 50 units turn online in 2026 in the downtown urban core. So within the 435 loop, only
Yep.
project that's online over 50 units. That's good for me because there's going to be obviously pent up demand because more and more people are moving here, et cetera. So in theory, I should be able to outperform my projections. But at the same time, it's sad to me because the housing problem that we have here, because we need more of it, is not going to get any better. There's not enough cranes in the sky. There's not enough buildings getting built because all the red tape in order to get the buildings built, the cost, the cap rates, the treasury. I mean, it's a big whirlwind of things. But granted, I will argue all day that if you can make a project work right now, whether that be low land cost, whether that be someone rolling equity in the deal, a plethora of different ways. But if you can make it actually work and not lying to yourself or on a spreadsheet, if you can actually make it work right now and break ground in the next 12 to 16 months, I think you're setting yourself up for immense success here in the Midwest markets.
Let's see. I was going to try to share a screen, but what you're looking at is a proposal I did years ago, which is not relevant to our conversation. But I was going to share the 10-year Treasury, and I think one of the things that I have found distressing, particularly in the last 6 months, is that with the new administration and with all of the attention being paid to Trump and people, my view is they don't understand his full program, which is it's not just Doge, it's not just tariffs, it's a whole bunch of stuff. And I think we're still waiting for whatever the big, beautiful bill that's coming out is. And regardless of how we feel about that, that's the policy that's coming down the pipe. But I think, and Zach, you tell me if you see this as well. I think what happened during COVID is people anchored their expectations for interest rates and treasuries at like 3%, or on the 10-year at like a sub 1% 10-year treasury,
which is bad. By the way, that's not good.
Yes, it's not good, and but I and now 10% on the 10-year treasury is also not good, but right. But I've made the point, and I've had to make it repeatedly, is that when you zoom out on a 5-year horizon or even a 10 or 20-year horizon, the interest rates we have now are still actually really in line with what we've had for the last 20 years. And I think the same thing is true, so there's the treasury, right? So people are freaking out, and I think there's issues with that. Now, the reason why the 10-year is having an outsized impact is because what's also happened is because we had those years of 3%, now we have a lot of properties that have excess, I'll call it excess valuation. And so what I see a lot of owners happening now, if you bought over leveraged in 2021, you're getting hammered on interest cost. You're getting rent increases, but you're not getting the rent increases that you thought you'd get because you're not getting 10%
more expensive to even run it. Yeah.
Exactly. So your utilities are up, your insurance are up. So that's where I think people are really getting hammered, is especially now that you're coming into this period where those 5-year loans are going to start maturing. That's where I think you'll see the distress. But, I'm seeing on the broader scale and on the more economic development scale that the cities that are winning and the cities that are actually getting momentum, like what you're doing in Kansas City. And I'd love to hear more about whether there's follow-on developments or other people where your number of being the only one coming online is going to be changing, or if you're just the lone warrior out there. But what I see is that the cities like Kansas City that have been let's say a tier 3 city for years, that have opened their doors and said, we want development here. We need more things happening. We've got the trolley car, we've got the park, we have things going on in West Bottoms, we have winning sports teams, we have things happening that are conducive to growth. And I'd say that juxtaposed to St. Louis, which is the cities that are not growing are the ones that have not humbled themselves to realize that if things have not been going well, nobody owes it to you to bring their dollars and their capital there. And if anybody knocks on your door, you better treat them well and invite them in. I always tell this story. When I lived in Dallas, so I grew up in Los Angeles, lived in Dallas for 10 years, and this was the early 2000s. The general sense, like if you were going to do your project, the Aladdin in Dallas, you might have said, hey, I think I need $10 million to do this project. And somebody in Dallas would have said, you know what, you need the 10, but you better make it 20. and you better do it a little bit bigger, a little bit better. Now the Aladdin's a little bit constrained, but you get the sense. The experience I've had in St. Louis for the last 10 years has been the exact opposite. It's, ooh, are you sure you want to spend 10? You might want to, do something a little smaller and do it for 3. And, you might want to not use it, very much leverage, and, it's going to take time. And so it's that luxury of diminishment and time versus the urgency of more and faster. And that's where you see a lot of the growth in Texas. And are you starting to see that in Kansas City, this sense of more and faster and capitalizing on those positive numbers that just doesn't seem to be materializing in other places?
Yeah, I mean, there's definitely still some hurdles, educating council members and other city officials on with tax abatements and TIFs and other forms of incentives. I think traditionally, some individuals view that as, oh, it's just lining the developers' pockets. They're just going to they can do the project either way. That's especially not the case right now. I would argue that I don't know how a single project works anywhere right now in the Midwest without development wise, without some sort of tax abatement, right?
Yeah.
If you're doing something where your taxes at the end of the project are going to be $500,000, and you can get a tax abatement that makes it so it freezes at $100,000, that's $400,000 a year added to your NOI that could help juice returns to your investors. Because again, at the end of the day, it is a financial investment where those people that are putting up their hard-earned money, they want to see a return on that. It's got to be worth the squeeze and worth the risk amid all these tariffs and at costs and everything like that. At the end of the day, people are doing these development projects to make money. And so it's a big educational game at this point, of just trying to educate the right players and right people of how things work. What is a good abatement? What is too much? And again, every project's different. But how all
Yeah.
that's
Are you seeing a shift with the current administration seemingly pulling funds away from local municipalities and getting more resistance to any sort of abatement or incentive?
That's a tricky question. Again, I think it just depends project by project. I would say that our current municipality and government is definitely not as lenient in a way as they were 10 years ago. But that's because 10 years ago, downtown Kansas City was a ghost town, right? People would come down here for work and they could not wait to get the hell out of here. Versus now, they're coming down here for work and, they didn't even drive. They walk to work because they're living downtown. So I understand that with more developments and more things happening and more people downtown, obviously it creates in theory, a more financially stable investment. But at the same time, 10 years ago, back to interest rates and cost, it looked very different. So what a 100% tax abatement for 10 years looked like 10 years ago, or even 5 years ago, that same abatement, although there's obviously a higher demand and rents are higher, et cetera, now that abatement in theory could be worse now, even if it's the same, simply because it still doesn't help justify the cost and the additional risk, even with the population growth, with the rent growth and all of that. Again, it's a big math equation. And sometimes it's a math equation that you can't put on Excel. It's just a gut feeling. Yeah, I mean, it's definitely interesting.
Yeah. What are you hearing from investors? What are they worried about? What are they, calling you at midnight saying, "Hey, Zach, I woke up and I couldn't help myself. What do we have going on here?"
I don't have any investor heartburn right now, which is great. That was the beauty with the Aladdin and even this upcoming project of the strategic partners and the strategic investors that understand that things are going to go up and down and sideways and slantways. There's going to be problems, and that they trust me and my partners to execute and find solutions to those problems. There's not a lot. I would say that finding a stabilized deal that works in maths right now is pretty much impossible. With development, again, it's all just the risk adjusted return. For this upcoming project I'm doing, it is how quick can I get my investors their money back and then just hold in cash flow. A little bit different than like the Aladdin, where it's, hey, it's going to be 3 years before anyone sees a cent, if even that. and then, refinance long-term debt, a long-term and hold and play. Every deal is different. And again, it just depends on what those individuals want. But at the end of the day, I think investing in real estate is becoming more and more prevalent and needed, especially given the volatility with the stock markets, the treasuries, et cetera. Or if you do invest in real estate, especially development projects in creative structures, it's almost like a hedge. That's one way of looking at it is A, it's a hedge, and B, at the end of the day, it's a tangible asset, right? If you believe in the metrics of an area over a 5 to 10 year period, and you look at the investment from, hey, yes, the investment works. Let's assume that, screw the math. Do I think that this land or this area is going to be better in the next 5 to 10 years? Okay, if the answer is yes, then you can't put that on Excel. I'm not going to trend my rents because I think that in 5 to 10 years the area is going to be better. But it should make you feel a lot better about that investment because it's okay. Well, here's where it is now. I don't think it's going to get worse. I think it's going to get better. And even if it stays the same, I can always still touch, poke, and feel that building, that land, etc.
I think that's so critical, especially if anybody ever watches this, and if they happen to be in local or state government. I think that is such a critical disconnect that my impression is becoming more and more, and I don't know what your experience is, that a lot of the economic development folks and the kind of city administration, or like we have a development corporation here, their outlook does not take into account what you just said. Their outlook is essentially when we close the deal and when we satisfy all the terms of the abatements. There's no sense that a developer or an investor or a development group is zooming out and saying, what do I think about the longitudinal trend that's taking place in this place?
And I'll give you a
And
great example. I mean, 10 years
yeah,
ago, Cordish companies came to Kansas City. They obviously built the Power and Light District, and they came to Kansas City and said, hey, we're going to build a glass tower. Okay. And keep in mind, this was in Kansas City. There was no glass tower. There was nothing. There was
nope.
no apartments downtown because no one wanted to live there because it was sketchy and crime was high and it was just bad. They said, yeah, we're going to build a glass tower. The city came to them and said, okay, good luck. Well, what do you need from us? Like, we're in. If you want to build it, whatever. And they got a really, really, really good deal to build that building because the risk at that time was they had to look out. Cordish looked out in the long term and said, I think that this is going to be a pivotal investment and that this will work, and then we can continue to do it. And it did work. One Light was a huge success. People moved in. When One Light opened up, I think they were getting $1.30 a square foot rents. One Light right now is over $3 a square foot. Well, One Light and then
Right.
2 Light and 3 Light, and then they'll break ground on 4 Light this year. And the problem I have though with people is that they view that because they set their incentive structure in place 10 years ago, and it's still in place right now, people are upset that they still get all these great incentives because of a deal they negotiated 10 years ago. I would counter that and argue they took a huge risk 10 years ago.
Yes.
And if you're a first and early adopter, hell yeah, you're going to get the best deal. It's just how it works. There was
Not only that, without them, there's no power and light.
Exactly. There's not all this urban sprawl. There's not billions of dollars of development happening downtown. There's not a $500 million new tower coming up, breaking ground this year. There's not the South Loop Park's not happening. Barney House isn't happening. Aladdin's not happening.
Yes.
All these other things aren't happening. And the hard part I have with that is people don't look at what that then created. Yes, they got a juicy tax abatement and they're making money. That's awesome. But that does not translate to them getting a sweetheart deal. That because of that translated to billions of dollars of development and hundreds of millions of dollars benefiting the local tax jurisdictions over those last 10 years, but even more so over the next 10, 20, 30 years here in Kansas City. So again, if you're first, you're taking the biggest risk, but also you can have the highest reward. I mean, that's why we're in development, right? If we wanted to go be a broker, you can go be a broker and go make good money, but you're not having to take as much risk. Being in development, there's years that you make no money, years you make a lot of money. I have yet to figure out when that time is in which you make money. Hopefully sooner rather than later.
Right. Hey, don't worry. There's people in St. Louis who would say they kind of missed that whole story about Cordish building the towers and power and light and kind of that foundational piece, and they would just say, well, Patrick Mahomes is winning Super Bowls, and so that's why Kansas City is growing. That's what's happening there.
And it does,
And
and that doesn't hurt. That definitely doesn't hurt. There's definitely
nope.
been a spotlight. We had the NFL draft. We're a World Cup host city next year, which is going to be unbelievable. I don't think people realize the magnitude of having 650,000 visitors come to your city. Almost doubling your population in the urban core overnight.
Yeah. Are you going to be ready?
That's a tough question.
Depends on who you ask.
It depends on what area. When you say, "Are you ready?" Are you ready from a hotel and living situation? Not yet, but I think we will be. Are we ready from a transportation standpoint? Kind of. We were the first city to announce that we're bringing in a massive fleet of more buses and stuff. But what I talk about with council and other members of the city is that, yes, we need to focus on the World Cup and that it's happening and it's going to be there. But how can we take the momentum from the World Cup and have that play into more of effect over the next 5 years after the World Cup? We don't want it to just be cool, World Cup, let's get all these improvements, let's get all this done, and then World Cup ends. All right, let's go back. We're good now. We hosted it. It was great. How can we feed off of the momentum and all the infrastructure stuff we're doing, the transportation, all this economic development? How can we catapult that forward? Of the World Cup is not the end date. The World Cup's just the start. It's just the beginning. How can we shift our mind to that?
The models for that, which I always point to, and I talk about the potential of something like this in St. Louis, is I think it's the '88 Los Angeles Olympics and the Salt Lake City Olympics. And the reason why they were successful in Los Angeles in the '80s is that they did exactly what you're talking about. Is they used the funds for the Olympics to create amenities that have really transformed communities over the decades, right?
Long term, not just, hey, let's just create this right now, and then when the Olympics are done, cool, like it's still going to be there, but let's, it's fine. No, how do you like with the streetcar, for example? We're having the streetcar expansion that will be done before the World Cup. That's awesome, but then it's not, all right, cool, we extend the streetcar, World Cup happened, Godspeed. It's how do we continue to encourage more transit-oriented development?
Yes.
How do we continue to expand the streetcar, going east and west? How do we do all these other things? Again, it's not the World Cup for Kansas City is not the start. It's not the end. It's just the beginning, and it is a huge deal for Kansas City because we are the smallest city that is hosting the World Cup, and we have the quarterfinal games. We have the fourth most games that'll be in Kansas City out of everything else, and that's big. So are we ready? Kind of. Do I think we'll be closer to ready? Yes. There's definitely always going to be some logistical challenges no matter what you do. Again, bringing 650,000 people into a city over a 45-day period of time, I don't think people comprehend how big of a deal that is. And more importantly, I don't think people comprehend how big of a deal soccer and the World Cup is. This is not like the NFL draft. This is not like hosting a Super Bowl. This has the same economic impact as hosting 8 Super Bowls at the same time. Billions of dollars of economic development is going to be happening in feeding our city. I hope that the bars are ready and that they're educated on it because they're going to need to have a lot of supply and stuff. And so hopefully all this tariff stuff doesn't really affect them, or short term it might, but by the time the World Cup comes, especially for Kansas City, hopefully they're in a position where they can still generate a lot of revenue.
I am increasingly bullish on Kansas City. Every time I read an article about I coined the term years ago, but there was an article about the Texodus, and the Texodus was talking about Texans moving north to Oklahoma, which was shocking because this is spending time in Texas, you would not consider going to Oklahoma as a real place. But the other piece the article missed is that the North Texas suburbs are essentially in Oklahoma already. So it's really more of like, do I want to live in the middle of nowhere in North Texas, or do I want to be in Oklahoma City? But what I see happening and what I expect is, Kansas City is really the easternmost Western town. And I think if there is a migration out of Texas, out of Florida, out of some of the places that, let's call them just the red states that have been growing because the market gets too expensive or something like that, Kansas City is is probably one of the more attractive places to go. It is
The cost of living
central.
is extremely cheap here. Housing,
You
well,
have
some would argue it's expensive. It's not. I mean, the
compared
cost
to
of living.
what?
Yeah, I mean, yeah, exactly. It's a great place to live, great place to raise a family. Some of the best public school systems in the country are here. There's a lot of reasons to move to Kansas City.
I think even more so, it is a place that as people come and invest, that to me, my impression in Kansas City is that it's a more open place. It is not the closed insular culture of like, oh, well, you're not from here, so you don't have anything to say about it. It's, hey, come on in. I think also the critical indicator for me is that you've got Highland Park Village Management that's bought Westport Plaza, the investment that they will make, the management that they will bring, and you've got everything going on downtown. But if you start to see an increase in investment around the plaza and you see kind of a renaissance down there, then you have kind of like a two front development that, and I think that the streetcar's going down there, right?
Yeah, we almost have like 5 different major areas of Kansas City that are seeing so much development and will see so much development over the next 3 to 5 years. You have the West Bottoms, you have the Berkeley Riverfront. West
Yes.
Bottoms, half $1 billion getting developed there over the next decade. You have the Berkeley Riverfront. That's $800 million getting developed there. That's where the KC Current Women's Stadium is. Apartments, retail, you name it. So $800 million going there. The plaza, those owners bought that, and they're getting ready to park about $400 million into that. There's an RFP out for a very cool project that is going to get announced somewhat soon down on the plaza that will be monumental for our city. Then you have downtown that is seeing massive growth with 4Light will be done. 4Light will break ground, the Barney House Plaza, the South Loop project, the 800 Grand Tower, the Aladdin. And then then you also have the Crossroads, which is seeing unmatched sprawl too. 20-story tower just broke ground a couple weeks ago. A lot more development coming. So you really have those main pockets that are all, I mean, it's 10 minutes. That's all within 10 minutes. And all that's within the streetcar line. And so that's what's
connected, right?
Yep.
Connected by the streetcar. It's easy to forget, people in St. Louis or anywhere else going to Kansas City, it's easy to forget all of everything that's also started in River Market and over in that area by Barquet, because it's not in that linear vision. You got to use your peripherals to see all these other things. And when you zoom out, you're right. You do have 5 hubs of development going on in Kansas City, critical piece that they're all connected.
And and that's not even anything to do with the suburbs whatsoever.
Yes.
It's just, I mean, go to Lenexa and there's billions of dollars break ground. Every time I drive over in Lenexa, I'm like, holy shit, that's another, when did that break ground? It's almost done. That's crazy. Another 700 breaking ground this week, I think, over there. I mean, it's crazy. There's so many different pockets and so many different areas of growth. And it's definitely an exciting time.
What are you seeing? What are you excited about outside of Kansas City, outside of the Aladdin? What are you excited about? What are you interested in as an emerging trend, either in historic redevelopment or just housing, apartment production in general?
I think AI is going to be really pivotal in the transition between the older generation ownerships and the younger generation. And if you can leverage that correctly, I think you're going to be able to automate and streamline things. Whether that be in the prop tech space with commercial lending and banking, whether that be from a management and operation standpoint, being able to, maybe cut your payroll down, or even from an investment analysis review, being able to look at twice the amount of deals in half the amount of time, to be able to act quick. Because that's the biggest thing that people don't realize with development is when you do have a project that comes to you, that is, it's a good deal and you have to act quick, you better act quick. Otherwise it's going to go. So, that's why I'm excited about my next project, because that's exactly it. It was right place, right time, right relationship. Cool. Let's go. Let's act quick.
What's your hot take in real estate right now? What's your either countercultural or hot take view of what's going on in the market or anywhere else, just in real estate or investing?
Hot take. A hot take is I think that office will come back a lot stronger. Not C-class office. It's got to be. I mean, I think creative office space is going to be fine and continue and get back to where it was. But I think if someone were to build hypothetically a spec office tower in Kansas City, I know it would work, but risk and money and all that, but it would work. Someone would move in. It's just obviously it's extremely risky, and it's kind of hard to get financing on a $500 million glass
Right.
spec office tower without a tenant. So I think that office is going to eventually come back. Why? You have people still want to like work in a cool spot and go to the office. If people say, "Oh, I work from home and I'm more efficient," like that's just lies. That's just not true. There's so many studies that show that's just not true. I work from home. I always say I go with the wind. Someone asks me where my office is. I go, well, it depends on the day. Right now, I'm in the power and light building working, and then in about 5 minutes, I'll be on a phone call here, and then I have to go to the Aladdin. I go with the wind, but especially corporate jobs and things like that. I think the resurgence of office will eventually come. When that is, I don't know. I don't have the magic 8 ball.
I actually think I was reading an article. I was shocked. I think it was yesterday. It was talking about how if you actually look at some of the data from like a CBRE or a Colliers in major markets, San Francisco, New York. I didn't see Dallas, but the office market, the vacancies are actually really low. Even
Class A, Class A office in Kansas City is like 85%. So like,
yeah.
That's not horrible. Now you go to the smaller sector side of the C and B class stuff. It's definitely a tenant's market, but I think that things could continue to shift.
All right, controversial question. I have my hot take is I think the conversation around affordable housing and housing affordability is 80% a sham, and I'll explain that. Whenever I hear people talk about a lack of affordable housing or a need for affordable housing, it is always in this nebulous sense of, well, there's just not enough affordable housing. And in the instances where I've been able to press people on that, what you end up with, and this is my hot take, is yes, people are being burdened by high rents, but a lot of that is regulatory, taxation, overhead costs. It's not the greedy developer raising rents.
You can't educate people. Like people, there's no way to educate people on that. Of like, hey, it's not me. Like you don't want to point fingers and blame, right? It's not, but it's not me as the developer saying I'm raising rents because I want to milk you and take all your money. It's, hey, I have an investment. I do need to make money, but I have an investment to pay people back, a bank back, my equity partners back. But I wouldn't have to charge this much if it didn't cost so much. And by cost so much, that could mean interest carry, which means time. It could mean all the different permitting and legal fees. Like again, an investment in an area or in a building, et cetera, it's a math equation. You have to get X rent if it's going to cost X amount. And if you could lower the cost of X amount, which construction cost is one way, interest rates are one way, but also red tape is one way, well, then I don't need to charge X now. And you wouldn't have to. And then there'd be more development, which then translate would still bring this down. So it's just an inverse effect that, it's hard to educate people on. Again, more housing equals more affordable housing. We still need actually more affordable housing too. But if we want more affordable housing, you have to incentivize it. I said this a couple times where if you had the opportunity to make $5 doing this, right here, or you had the opportunity to make $5 doing this, well, doing this takes you twice as long. It is a pain in the ass up front, during the construction, once you're leasing up, and at the sale, and there's so many red tapes and hoops, and it just sucks. It's horrible, horrible, horrible. But you make $5 doing this, you make $5 doing this. Which one would you choose? This over here all day. Well,
easy one all day. Yeah.
Affordable housing, and this is market rate housing. If you want more affordable housing, you have to incentivize it. The juice has to be worth the squeeze. And as much as people might not like that, if you're a developer and you're going to do affordable housing, you're only doing affordable housing because you think you can make more than market rate, because nobody is intentionally putting themselves through more brain damage, more cost, and a less return just for fun. It's not how that
All right.
works.
I'm gonna finish my example, and then I'll let you get your final thought because we're coming up on the hour. So awesome. I think the other half of this is I suspect the majority of the affordable housing, if you strip out places like San Diego, which are unaffordable, right? The income, the local incomes and the tax burden don't match the demand for the property values, right? And then there's the regulatory piece, which is you can't build. But I think in a lot of places, what's happening is there is, when people say there's not enough affordable housing, it's there are not enough houses that I would want on an aspirational basis in the places that are highly in demand and desirable to be in at a price point that I'm willing to pay given
Exactly.
my income, which is median, right? So
Well, it's
yeah,
like,
I
oh,
would.
yeah, it's not for like this isn't affordable. It's like, well, yeah, it's like the most vibrant pocket of the area, and this is where everybody wants to be. No shit, it's not affordable. That
Right.
again, demand. That's just what it is.
Yes.
It's just, yeah.
And
Uh,
that's a problem that like developers and real
I don't know.
estate can't solve, right?
No,
It's well, and even on the, you think about incomes, right? Like, when you think about building right now, you made the example, it costs $300,000 a unit in an apartment building. It costs $300 or $400 a square foot to build a new house. So even if I'm building 1,000 square foot house, I still have to sell it for $300,000, and that's not with the developer making out like a bandit. I mean, that is a raw cost, and that is labor, materials, tax, and everything else, and insurance. So that's just what it is. And sorry, like that is the cost basis. And I suspect also with the interest rate conversation, I think a lot of people's basis and their mindset about valuations is stuck 10 years ago, and it has not caught up with the fact that this is what housing costs now. And I think a lot of that is because incomes haven't adjusted yet. So
correct.
my final hot take is that I think what we're looking at right now, I think we've been in a recession for 2 years, if not an economic, then an employment recession. I suspect that means that coming out of this, I think to your point, you're going to see just an absolute rocket in incomes, profitability, office tenancy, new business creation. Once everybody kind of gets their feet back on the ground and they say, okay, we got through COVID, we got through Trump, we got through Biden, our feet are on the ground, and here we go. Now we can get some certainty for the next decade, and we're off to the races. That's my hopeful thought. What do you have for us, Zach, before we sign off here?
That's it. I mean, I just want to say thanks for anyone that hopped on. I can't see who hopped on and everything, but this was fun. We'll definitely have to do it again. It's always fun chatting with you. Godspeed. Keep me posted, and let's continue to build.
Awesome. Sounds great. Look forward to seeing you next time in Kansas City. Great talking. Thanks for everybody who joined. Coffee next time.
Godspeed.